Because of the incredible benefits federal employees have, they need to be more vigilant than most when looking at long-term tax planning. Today, we're going to focus on two of those benefits, and one of them is probably going to surprise you. In this episode, we're going to share some of our best tax strategies for federal employees and list multiple action items that you can do to minimize taxes. Welcome. I'm Ed Smith, President of Valor Wealth Partners, where we're dedicated to educating federal employees on how to maximize value from your complex and often underutilized benefits. As we talk today, we're going to look about the year-end tax planning. So when you're trying to figure out what do you do in the last couple months of the year to make sure you're maximizing taxes and using your federal benefits to be able to do that. So there's a lot of things you can be able to do that anybody can be able to do, or everybody should be looking at. Charitable contributions, maybe it's like a donor advised funds. There's a lot of different things that you might be able to do in the year end. Maybe it's business owners, you have other things. But as a federal employee, there's some very specific things we want you to be able to do. Now, most people, when they look at saving money on taxes, what they're trying to do is either minimize the amount that they're going to pay to the IRS in April or maximize the amount of a refund they're going to get. This is short-term thinking. We want to look at long-term tax planning, which means we're trying to reduce the overall taxes we pay to the government over the course of your lifetime. Now, this is a different concept than what most people are taught, because most people hire an accountant to get them more money back. And we're going to go against some of those rules because we're not trying to look at it on a short-term basis. We're really trying to say if we can save hundreds, if not millions of dollars over the course of your lifetime in taxes. Not saying that you will be able to do it, but by using some of these strategies and the calculation we've seen this over and over again, that people have maximum tax savings by looking at things in a different way. One of the things that we have, one of the biggest problems with talking with clients about is the concept that the money in their different types of accounts is theirs. And we're going to get into the different types of tax types of accounts, but I really want to get the concept across that when you look at, say, a traditional IRA or your TSP and the traditional component of that, and maybe you have $1 million in the TSP, that $1 million isn't yours. You owe money to the federal government and possibly to the state government. So let's say you're in the 24% tax bracket and you have $1 million in the TSP. That means $240,000 of it is the federal government's. We're going to say, when should you pay that bill? Should you pay it now or should you pay it later? When does it make sense for you? And so we're going to look at some of these concepts. But first we have to really get through that you're holding money for the federal government. That might not be all that's going into your bank account from that retirement account. So that's a big thing to get over. But once you start realizing that it's a lifetime of taxes, not an annual basis, this can probably help you out on a lot. In the intro to the video, I talked about there's going to be two benefits that we're going to really focus on today. So let me get them out in the open right now. First, TSP, we were just talking about that. When should you pay taxes on that? And the other one that's probably going to surprise you is FEHB, or Federal Employee Health Benefits. Your health care plan is another way that you can save taxes. I know that may sound a little crazy, but you'll see that there's some ways that you can be able to save money on taxes by just looking at things in a little different way of a concept. And so hopefully this is going to be very valuable for you, and we can save you some money on taxes just on those two benefits as a federal employee. First, though, we want to get into a little bit of understanding about the tax code so we can be able to frame up some of these different concepts. So when we're looking at different types of tax accounts, there's basically 4 types of tax accounts. Most people look at 3, but there's actually 4, right? The first one is a taxable account. And this is a type of account, maybe a bank account, checking account, a certificate of deposit, could also be an investment account or a joint account that you have. This type of account has been taxed already when it came out of your paycheck, and the growth or the gains on that account are going to be taxed when you sell the investment inside of the account, or maybe that when you receive dividends. But it's taxable on the gains, but not on the principal, because you've already paid taxes on that principal. The next type of account is what's called a tax-deferred type of account. Now, a tax-deferred, a lot of people look at a traditional IRA or maybe the traditional component of your TSP. Now, on this type of account, you do not pay the taxes when it comes out of your paycheck, so you have never paid the taxes. But when you actually take the distribution or take money out of the account and say put it in your checking account, you will pay tax on both the principal the amount that was originally put in, and the gains on that. So you have a double tax. It's not taxing it twice, but there's just a lot more taxes on that traditional side. The next is what's called a tax-free, and this is a lot of times looked at a Roth IRA. So a Roth IRA, it's taxed from coming from your paycheck before it goes into that account. Okay, so you've already paid taxes on the money that's in the account, but the gains is what we have to look at. And because it's in a retirement account, you do not have to pay taxes on the gains because you paid it earlier, and you get the special tax treatment for retirement. Now, both the traditional IRA and the Roth IRA have a lot of restrictions on them and complexities that you have to follow certain rules or you'll be penalized. We don't need to get into them specifically today, but just understanding that both the traditional and the Roth have a lot of tax requirements here, or handcuffs to basically say you can't touch your money at certain points, where the taxable account, that first type of account, doesn't have those types of restrictions. Now, there is a fourth type of account. It really doesn't have a name, but I call it the triple tax-free account. And this is like an HSA. And actually, it is an HSA because they're the only ones that are out there. An HSA is a health savings account, and it can only be found in a high-deductible health plan. We'll get into a little bit more, but now you start seeing where we're talking about the healthcare side of things. Now, a HSA is not taxed when you earn it or you take it from your paycheck and you put it in the account. It's not taxed. It grows tax-free. And then when you take it out, it's tax-free as long as it's in a qualified expense, either for healthcare or an age requirement that you're able to do. So an HSA is triple tax-free. Don't pay taxes when you put it in, don't take taxes as a growth, and it doesn't pay taxes when you take it out. Unlike the other three that we mentioned, there is some type of a taxation. It's the only account that I know of that can do that. There are some other insurance programs that might be able to do it, like long-term care, that might have some tax favorable status like that. But as far as an investment account, an HSA is the only one like that. Since we've just been talking about the HSA, let's dig a little bit more into this. So when we're looking at that benefit of FEHB, or Federal Employee Health Benefits, how do we maximize this for tax purposes or year-end tax planning? And we'll get to why it's specifically timing is important. But I think a health savings account is a really great investment vehicle that a lot of people don't use because it's attached to a high deductible health plan, or HDHP. A high deductible health plan is a very bad name. All right. And people don't even look at it because that high deductible, that fear that if they do get sick, they're going to pay a very high deductible. When in reality, especially under FEHB, because you have so many choices and so many options on a high deductible plans, there's not just one, that because of that, you can actually find some really good high deductible plans that may match your needs. Now, we have a whole video on high deductible health plans, so I'm not going to get onto specifically, but please watch this. It really helps you understand that it's not just the premium that might be different. You can actually get some free money into that HSA that I talked about, but also you can be very helpful on the different ways of different costs that are inside the high deductible plans. Now, a high deductible health plan is not for everybody, but every federal employee should be looking at the benefits of them and seeing if it is good for them and their family. If it's not, that's great, but at least you looked at it to see if that was good. But please don't discredit it just because of the name or because somebody says, oh, these are horrible. In the video that we have, it shows you both premium costs and also the overall cost from either a low income or low usage, an average usage, and a high usage or max out of pocket. So there's some very different concepts. And even a very bad year, a high deductible health plan is generally cheaper than some of the other plans. Now, different areas of the country have different plans, so please look at this a little bit more. Okay, but again, it's not for everybody, but we want to make sure that everybody is looking at this. Why is this timely? Because you can only sign up for an HSA or high deductible plan during open season. And open season is normally the second week of November, and it goes into December. So it's, again, a year-end tax planning. It will start in January, but you have to do this now or when open season opens. So please take a look at this and really try to figure out if this is timely for you and it's good. There's something that you should look at with every health plan or every health plan change is really talking to your doctor before you make these changes, because your doctor's office will know if this is something that's going to be good for you based off of the type of health care that you get and the type of services you get. So it's not something you just look at a dollar amount. Also talk and make sure that these are good options for you when you're looking at this. Now, HSAs can also be used outside of the basic HSA or HSA bank that you get when you do a high deductible health plans. They put money into this type of account, but an HSA can actually be transferred to an investment type of account, like a major brokerage firm like at a Fidelity or a Schwab or something else. There's a lot of different carriers out there that do HSA types of accounts, but you can actually make this more aggressive. Because you didn't pay taxes to get it into it, it's a larger sum of money. Because you're not going to pay taxes when it comes out, you can be more aggressive and it's going to grow. We generally recommend people do not use their HSAs for medical expenses. I know this seems really weird, but if you can maximize the tax strategies of an HSA because you had more money in and not taxed when it comes out, this can be one of the most beneficial accounts on a long-term basis, and at a certain age, you're eligible to take it out without any penalty, which means this can be really good into retirement. We have seen clients that put $30,000, $40,000 in starting off in the first couple of years, and this thing is just really growing, and because it's aggressive, if they're young enough, they can really maximize this. One of the caveats you really have to be watching out for is if you're about ready to go on Medicare or you're already on Medicare, you're not going to be able to qualify. So once you go on to Medicare, and this could be Medicare Part A, not just Part B, but if you're on Medicare Part A, you're going to limit yourself and you're not eligible to do a high deductible health plans. So that's one of the dangers of looking at the different types of health strategies to make sure it's maximizing and best for you. But please check this out because this could be a really good thing, and I think a lot of federal employees don't look at it, but because of all of your options under FEHB, this is a really good plan. Most of the high deductible plans I've seen have been incredible and really benefiting people. It's just sometimes people don't like how their work or how they have to plan ahead for some of the medical expenses, but definitely check it out. The next benefit we want to look at when we're looking at year-end tax planning is the TSP or Thrift Savings Plan. And we're really looking at, should you do a Roth or should you do a traditional? And you might be wondering, well, why is this year end? What is so specific about year end tax planning that you have to make this decision now? Well, when you're looking at the TSP and you're trying to find out if it's a Roth or traditional or what you should be into, you really have to look at how it's going to affect your long-term planning. Again, going back to that concept. And with federal employees, because you have such really good guaranteed income sources from your pension and Social Security, a lot of our clients also have like military pensions or some other type of incomes, or if they're a double federal employee couple, their income is even higher. So because their income is so high, they might have penalties on their Medicare, which is something called IRMA, Income Related Monthly Adjustment Amount. They might have a penalty once they start taking Medicare. Well, why is this so important when we're looking at Medicare is because if you retire at 62, which is a lot for most people, the ideal year to retire because of the 10% bump in your pension, Medicare looks at 2 years prior to say, what was your income in this year? Which if you get on Medicare at 65 would be age 63. So if you retire in 62, you have 1 year to get money out of your traditional IRA into a Roth IRA or traditional component into the Roth component of the TSP, which again has limitations. So it's looking at the big picture on the why is this such a big problem with the federal employees? Another thing that we have to be looking at is that according to current tax law, that the 12% tax bracket is going to go up to 15, the 22 is going to go to 25, and the 24 is going to go to 28. Now, this is planned to sunset in 2026. Now, I don't care what politicians are promising that they're going to do this or they're going to do that. I care about what the current law is, and until it gets changed, that's when we start reacting. We can do planning, but we don't want to be making changes based off of guesses or assumptions of what might possibly happen. Once it becomes a law, that's when we can actually start saying, how does this affect it? We look for these different things, but we don't want to act until we actually know how it's really going to affect you in those different areas. When we're looking at going beyond just the tax code changes, we see that a lot of federal employees aren't affected by the high income or high tax levels until they hit the required minimum distributions or RMDs in their 70s. But because a lot of times federal employees have done such a really good job saving, they don't need that money, and it just grows and grows and grows. But once you are forced to take that money out in your 70s, then you start seeing the bigger problem. And because you're starting to take it out, now you're going to be affecting that penalty that I talked about before in the Medicare. Okay, so let's look at an example here. Let's say you have $1 million in your TSP, and the TSP grows 10%. That means it just grew $100,000. So what we have to do is we have to try to get that under control and try to be able to look at how do we reduce that big taxable liability that's coming in the future, and do we reduce it early? Now, if the portfolio is going to grow at, say, 10% over a couple of years, and if you're just living off of your pension and Social Security, maybe a little bit out of your TSP, then this is really growing and big and big and big. And we'll see portfolios with multi-million dollars. And so when we look at these types of portfolios, the bigger your TSP or traditional IRAs get, the more of a problem this is going to be for those penalties and higher taxes. Now, I don't know where taxes are going to be going. But I do know that we're spending a lot as a federal government, and we're also looking at the deficit being pretty high. So with that, I don't think taxes are going to get lower on an income level. I think they're either going to stay the same or get bigger. And as a bigger percent means the bigger your TSP is, the more taxes you're going to pay. So again, we generally try to say doing it earlier than later. The only exception to that is when we're trying to be able to look at different things like planning for Social Security and when we should be able to take these different types of things out. So there's, or work type of things. So some of those types of plannings on when we take the money out of the TSP is different. We're going to actually dig down to two different levels on this, the TSP. One of them being as you're still working and should you be contributing to a Roth versus a traditional. And the other one is going to be once you're ready to retire or you're eligible to take money out of the TSP, should you do it or should you not do that? So when we're looking at trying to really answer that question, should you put new contributions to the Roth IRA or traditional, this is a complex question. It's not as simple of, yes, you should do it this way or that you should do it that way. You definitely want to be talking to somebody to be able to help you make these decisions. For most federal employees that we see, they're in the 22 or 24% tax bracket, which means they're not going to be in the 10 or 12% using the current tax code. It's just the reality between Social Security and your federal pension. And if you have another pension or some other type of income, you're going to be in a high tax bracket or a moderately high tax bracket. There's no way you're going to be able to get around this. So when you're saying, well, I'm in the 22% bracket now, do I want to pay taxes now or later? Since you're already going to be in a higher tax bracket later, it really doesn't matter one way or another. Okay, and we don't know what that's going to be in the future. So if the tax brackets go up, it would have been better to pay it in a higher level or a lower level right now. So this is just one of the things you have to be able to look at. Most federal employees that we see do come into this problem once they get into retirement. So the earlier you are, we can adjust this, that better it's going to be because you don't have a big traditional IRA component that you're going to be able to look at. Another area that we see that a lot of people try to have a little bit of trouble with is that they're told that the contributions that go into their TSP have to be on the traditional side to get the match, and that is completely not true. Any contributions into a Roth IRA will count towards the matching. The match will go into the traditional component, so you'd have both Roth and traditional, but at least you're not building up more of that traditional. That's going to be bigger and bigger by the time you get to retirement, which means more money that has to come out, more taxes, and then more complexity trying to squeeze out that money between 62 and 63 before you have to start paying Medicare penalties. Now, there are a lot of other reasons besides just taxation on why Roth IRAs, but that's for another video that we'll talk about that a little bit more of some of the other benefits that you have on that side. If you're a little bit close to retirement or already retired, now we have to try to figure out, should it be good to do a Roth conversion, meaning take money from the traditional and move it over to a Roth or not? Now, one of the first big problems that you have is that inside the TSP, you are not eligible to move from the traditional to the Roth. You have to first move it out of the TSP into a traditional IRA, and then you can move it from a traditional IRA to a Roth. Now, moving it from the TSP to a traditional IRA does not cause taxes, as long as it goes in that traditional IRA. So, and then moving it from the traditional IRA to the Roth would be taxes at a certain level. So when you're doing this, it is very complex math to be able to make sure that we're getting this right. The first thing that we have to be able to do is we have to figure out what is the appropriate tax bracket to fill up, or what bucket to fill up. Should it be the 22, the 24, the 32, even the 35% bracket. And sometimes it actually makes sense to go into the 30% brackets to fill them up for tax planning. All right? So that's first figuring out what bucket or what bracket to be in. Next, you have to look at your current year and figure out some type of an estimate of what you're projecting your year-end numbers to be. And so you can figure out where's your capacity to fill that bucket. So if you're at a certain level of income, you only have so much left in that bucket or that bracket before you go into another bracket. And we don't want you to be paying too much taxes. So you really have to do some advanced calculations about what are your deductions, where's your incomes, where's your sources of things, have you taken any distributions from IRAs? So just get a little bit complex on that. And the third thing, part of this this calculation of how to be able to do or how much to move is really looking at wrapping your head around the emotional side about paying taxes early. If you've never done this before, I can tell you it's a very daunting task. Most people really struggle with this, and we try to prepare people of the huge tax bills. We do tax Roth conversions, sometimes in the $400,000 range. We do 1 or 2 of those a year. Those are massive, which means there's going to be taxes over $150,000 for most people when they're doing that type of a conversion. And you're like, well, that's just crazy to pay $150,000 in taxes in 1 year. But this goes back to that calculation I was talking about. $1 million on a TSP and a 10% growth, that's $100,000 in growth. Now let's say you had $2 million. That's $200,000 of growth. To actually reduce the size of your TSP or traditional IRA, you have to do massive changes. $100,000, a $50,000 Roth conversion isn't even going to get the growth on your portfolio on an annual basis, and you're not going to get this monster under control. So it's really trying to be able to get change, and change is going to affect both taxes currently, but also long-term on like those IRMA penalties that we talked about earlier. Another big thing that when we're looking at this year-end tax planning is really trying to be able to position your types of accounts in the right types of ways. So once you try to figure out if or start moving money from traditional to Roth, if this is appropriate for you, it's maximizing these different types of accounts. And one of the things you want to be able to do is put slower growing investments in a traditional type of component, and then more aggressive type of investments in a Roth. Now, again, be appropriate for your overall risk score, but if you can maximize these different types of accounts and these investments inside the accounts, it could actually benefit you a lot more on a long-term basis. But having that flexibility can be able to do this. Now, again, year end is very important to be able to do this. And the reason why we look at Roth conversions is at the end of the year is because we have a really good grasp on what you've already done. If you've gotten money that you had to take out of an IRA, if you've gotten a bonus or something else, and it doesn't have to be just from the federal government, it could be an outside source, we have a really good grasp on where your income is going to be for the year, and we can plan it. With the current tax loads, there are no do-overs. So if you did a Roth conversion in January or February trying to maximize the second tax year and something happened, you can't reverse that. You used to be able to do, but you can't anymore. So that's why year-end tax planning is very important on this. And then again, for the people that are putting in and putting new contributions in, it's just setting it up for next year and planning on the all of the numbers that you want to be able to look at to be able to make sure you're maximizing this. Okay. We want the best for you and your family, so please get conflict-free, unbiased advice. Thank you for listening today, and hopefully we can help you out in the next video.